Have you ever thought about what might happen if you dove headfirst into trading without a parachute? That's essentially what you're doing when you ignore risk management in trading. You're jumping off a cliff and hoping for the best, without any safety measures in place to protect you from the inevitable fall. Risk management in trading is the parachute that protects you from significant financial losses. It's the buffer between you and the harsh realities of the market. It's the strategy that helps you navigate the tumultuous waters of trading without losing your shirt, your sanity, or your future. So, what happens when you ignore risk management? Well, let's paint a picture. You see an opportunity. You're excited, so you dive in, all in. But then the market shifts. Suddenly you're in free fall. Your capital is dwindling and there's nothing you can do to stop it. You're watching your hard-earned money disappear before your eyes. It's a downward spiral, and it's a direct consequence of ignoring risk management. The emotional stress that follows such a significant loss is equally devastating. The constant worry, the sleepless nights, the self-doubt, it all adds up. You start questioning your abilities, your decisions, your future. The mental toll is as real and as damaging as the financial one. And the worst part? It can all be avoided. With proper risk management, you can protect your capital, safeguard your mental health, and ensure long-term success in trading. It's not about avoiding risks. That's impossible in trading. It's about managing them, understanding them, and making informed decisions based on them. Remember, trading is not a game of chance. It's a game of skill, strategy, and most importantly, risk management. Without it, you're not trading, you're gambling. And the stakes are too high for such a reckless approach. Without risk management, you're essentially gambling, not trading. So what exactly does risk management entail? Let's dive right into it. At its core, risk management in trading is the process of identifying, analyzing, and either accepting or mitigating uncertainty in investment decisions. It's all about finding the balance between the potential for returns and the possibility of loss. Think of it like this. Risk management is your compass in the often stormy seas of trading. It helps you navigate through the rough waters, guiding you towards your destination while keeping you clear of potential hazards. Now, why is it so crucial? Well, without risk management, your investment could be as precarious as a house of cards. One wrong move and it all comes tumbling down. But with a solid risk management strategy, you're building a fortress, strong and resilient, capable of withstanding the ebb and flow of the market. As for the different strategies involved, there's a whole smorgasbord to choose from. Each strategy serves a unique purpose and is used in different trading scenarios. Some traders might opt for diversification, spreading their investments across various assets to reduce the impact of a single asset's performance. Others might use hedging, taking an offsetting position to protect against potential losses. And then there's stop-loss orders, a mechanism to sell an asset when it reaches a certain price, thus limiting the trader's loss. Each of these strategies and many others offer their own unique benefits. But the common thread running through all of them is their focus on minimizing losses and maximizing gains. They're not about making a quick buck. They're about ensuring long-term success, about making sure that every step you take is a step forward, not back. Risk management is not just a tool, it's a mindset. It's about being prepared, about having a plan for every possible outcome. It's about understanding that trading is not a gamble, but a game of strategy and skill. In essence, risk management is your safety net in the volatile world of trading. It's the difference between jumping off a cliff and carefully descending a mountain. It's the key to not just surviving the market, but thriving in it. Risk management is not a single action, but a combination of several key strategies. Let's delve into these key components that create a robust risk management system. First up is diversification. It's a concept that's as old as the hills and just as sturdy. Diversification is about spreading your investments across various assets to minimize the impact of a poor-performing investment on your overall portfolio. Think of it as not putting all your eggs in one basket. If one basket falls, you still have eggs in other baskets. In trading terms, if one asset performs poorly, others may perform well, balancing out your losses. Next, we have the stop-loss orders. These are your safety nets in the high-wire act of trading. Setting a stop-loss order means determining a point at which you'll sell an asset if its price drops to that level. It's about knowing when to cut your losses and move on. The beauty of stop-loss orders is that they take emotion out of the equation. You set them in advance and they execute automatically when the predetermined level is hit. No second guessing, no hesitation, just decisive action to protect your capital. Last but not least, we have position sizing. This is all about controlling how much of your capital is at risk with each trade. It's the antidote to the bet the farm mentality. Instead of risking everything on a single trade, you decide in advance what percentage of your capital you're willing to risk. It could be 1%, 2%, 5%. The exact figure is up to you. The key is to set a limit that aligns with your risk tolerance and stick to it. These three pillars, diversification, stop-loss orders, and position sizing, are interrelated and together form an effective risk management strategy. Each one supports and enhances the others, creating a system that can protect you from major losses and help you navigate the unpredictable waters of the trading world. These pillars of risk management provide a solid foundation for any successful trading strategy. They're not just tools for survival, but for thriving in the world of trading. Knowing about risk management is one thing, but how do you actually put it into practice? Well, implementing risk management strategies is like painting a masterpiece. It's not about random brushstrokes. It's about deliberate, calculated moves that together create a beautiful picture. Let's break it down into easy-to-understand steps. Step 1. Identify your risk tolerance. This is the cornerstone of your risk management strategy. Risk tolerance is essentially how much you're willing to lose. It's a personal decision and varies from trader to trader. Some may be comfortable with losing 10% of their capital, while others may only be willing to risk 1%. It's not about being brave or timid, it's about understanding your own financial situation and emotional capacity. Step 2. Set your stop loss and take profit levels. A stop loss is a predetermined level at which you'll close a losing trade to prevent further losses. On the other hand, a take profit level is where you'll close a winning trade to secure your profits. These levels should be set in accordance with your risk tolerance and the market's volatility. Step 3. Diversify your portfolio. Don't put all your eggs in one basket. Spread your capital across various assets to reduce the risk of a single investment wiping out your entire capital. This is a fundamental principle in risk management and investing as a whole. Step 4. Regularly review and adjust your strategy. The market is not static, it's dynamic, it changes, and so should your strategy. Regularly reviewing your trades and adjusting your strategy accordingly is crucial for long-term success. Remember, the goal here is not to eliminate risk because that's impossible. The goal is to manage it, to control it. It's about making sure that when the inevitable losses come, they won't wipe you out. And when the wins come, they'll be significant enough to make a difference. Risk management is not about avoiding losses. It's about surviving them, learning from them, and ultimately thriving in spite of them. Proper implementation of risk management strategies is a game changer in the world of trading. Why should you invest time and effort into mastering risk management? Let's delve into that right now. Imagine yourself in the driver's seat of a high-performance sports car. Just like how the seatbelt, airbags, and anti-lock braking system protect you, risk management shields your investment portfolio. It's not about avoiding risk entirely, but about understanding it, controlling it, and using it to your advantage. The benefits of effective risk management are manifold. One of the most prominent is long-term trading success. With a well-honed risk management strategy, you're not just playing for the short game, you're setting yourself up for sustained success over the long haul. It's like a marathon runner pacing themselves, conserving their energy for the final sprint. Your journey in trading is a marathon, not a sprint. A solid risk management strategy ensures you have the stamina to go the distance. Another key benefit is the preservation of capital. While every trade has a degree of risk, a good risk management strategy keeps losses within acceptable limits. It's your safety net, catching you when trades don't go as planned. It ensures that even on a bad day, you're not wiped out. You live to trade another day. And let's not forget about peace of mind. The markets can be a roller coaster ride with highs and lows that can test your nerve. With a reliable risk management strategy in place, you know you're prepared for whatever the markets throw at you. It's like having a sturdy umbrella in a storm. You might get a little wet, but you won't be drenched. Risk management is not an optional extra. It's not a luxury, but a necessity. It's an essential part of trading that separates the successful from the unsuccessful, the professionals from the amateurs. Risk management is not just about protecting your capital, it's about setting the stage for consistent, sustainable success in trading. Because in the end, Trading is not just about winning, it's about staying in the game.